All right, so ever stop and think about this? How does an entire country, with literally trillions of dollars flying in and out every single day, actually balance its checkbook with the rest of the world? I mean, it sounds kind of impossible, right? But believe it or not, there's a system for it. And today, we're going to break it all down.
I mean, just think about your day so far. That coffee you had this morning, the phone you're probably holding right now. Yeah, chances are huge that parts of them crossed at least one border to get to you. We're talking about this constant, non-stop global flow of goods, services, and money. And the scale is just absolutely staggering.
Okay, so with all this stuff zipping all over the planet, how does any country actually know where it stands financially? You know, is it making more than it's spending on the world stage? Is it digging itself into debt? Seriously, how does anyone even begin to keep track of it all? Well, the answer really starts with a pretty simple idea: the open economy. Because, let's be real, no country is truly an island anymore. Today's economics, it is all about the connections.
So, what's an open economy? It's really just what it sounds like, an economy that trades and interacts with other countries. The opposite, a closed economy, is basically a unicorn these days. It hardly exists. And that's key because all the fascinating, complex stuff we're diving into today happens because these economies are open.
So these connections, they basically happen in three main ways. First, you've got the output market. That's just trading goods and services. Then there's the financial market for buying and selling assets like stocks and bonds. And third, the labor market, which is all about people choosing where to work. Now, all three are important for sure, but to really get a handle on a country's global checkbook, we're going to zero in on the first two. Why? Because that's where the biggest money flows are.
All right, so if you think of those markets as the playing field, there's got to be a way to keep score, right? And there is. Countries use an official scorecard called the balance of payments. You'll often hear it called the BOP.
The easiest way to think of the BOP is like a country's ultimate, super detailed financial statement with the rest of the world. It tracks everything over a specific period, usually a year. I mean, everything. Every single car sold abroad, every dollar a tourist spends, every share of a foreign stock someone buys. If it involves a transaction that crosses the border, you better believe it's in the BOP.
But of course, you can't just dump all of those transactions into one giant spreadsheet. That would be chaos. So, the BOP is really smartly organized into two main accounts, the current account and the capital account. Think of them like two sides of a ledger, or two key chapters in this whole financial story. So, let's dig into the first one.
Okay, first up, the current account. The best analogy for this, honestly, is to think of it as a country's checking account. It's all about tracking the day-to-day, here and now flow of money coming in and going out.
So, what exactly is inside this national checking account? Well, it's basically four main categories. You've got trade in actual physical goods, think cars and food. Then you have trade in services, like banking or tourism. Third is income, like money earned from investments abroad. And finally, you have what are called transfer payments. That's one-way stuff, like foreign aid or a worker sending money back home to their family.
And you can see just how detailed this all gets. Trade in goods, that's your classic exports and imports, the stuff you can touch. But look at trade in services. That covers this huge range of things, from shipping and banking all the way to software development. It really is the total picture of a country's daily cash flow with the rest of the world. All right, that brings us to the second half of the balance of payments, the capital account. And if the current account is the nation's checking account for all its daily business, then the capital account, well, that's its long-term investment portfolio.
Yeah, this account isn't about day-to-day spending and earning. It's about ownership. It tracks the really big-ticket items, things like major investments. Think a foreign company building a huge factory in your country. It also tracks things like large-scale borrowing and other major financial flows between countries.
And here's a look at the main components. You can see it separates long-term stuff like direct investment from portfolio investment, which is more about buying and selling things like stocks and bonds. But here's the key takeaway, the most important thing to remember. Anytime an asset, a factory, a bond, a stock, changes ownership across a border, it gets recorded right here in the capital account. So let's just boil this all down to its simplest form. The current account, think cash flow. It's the money coming in and going out from all that buying and selling of goods and services. The capital account, think ownership. It's all about the buying and selling of assets. So one is about what you earn and the other is about what you own.
Okay, so we've got these two big accounts, and they seem totally separate, right? One for daily cash flow, one for long-term assets. But here's where it all comes together, and it's actually kind of genius. They aren't separate at all. In fact, they have to balance each other out. Let me show you how. This quote really just nails it. Think about your own budget for a second. If you spend more money in a month than you earn, you've got a problem. You have to cover that gap somehow, right? So you either pull money from your savings or you borrow it, maybe put it on a credit card. Well, it's the exact same logic for an entire country, no exceptions. And right here, this is the aha moment. This is the fundamental ironclad rule of the balance of payments. The current account and the capital account must balance each other out. So if you have a deficit in one, let's say you're buying way more stuff from other countries than you're selling to them, that deficit has to be paid for by a surplus in the other. That means you're attracting foreign investment or borrowing money. They always sum to zero.
So what are the official terms for these situations? Well, if a country has a current account surplus, it just means its receipts are greater than its payments. It's earning more from the world than it's spending. In short, it's a lender to the rest of the world. On the flip side, a current account deficit means the opposite. Payments are greater than receipts. The country is a net borrower from the world.
And here's a perfect example of how this looks with some real numbers. Take a look. The current account has a deficit, a negative balance of $38 million. So how did the country pay for that shortfall? Well, look right below it, at the capital account. It has a surplus of over $41 million. That means money from foreign investment and borrowing more than covered that spending gap. Now you'll see a little line for errors and omissions, which is just for tiny accounting adjustments to make it all perfect. But the bottom line, the overall balance is zero. It always has to be.
So after all that, why should you care? Why does any of this matter? Because the balance of payments isn't just some boring accounting exercise. It's basically a country's economic report card. It answers huge questions like, is this country living within its means? Is it a place the rest of the world sees as a good investment? It really reveals the true nature of a country's financial relationship with the entire globe.
And that leaves us with a really fascinating and kind of tricky question. We almost always hear that a trade deficit is a bad thing, right? A sign of weakness. But what if that deficit is being paid for by a massive surplus of foreign investment in the capital account? What if the world is just lining up to invest in your country? Is that a sign of weakness, or could it actually be a sign of incredible strength? That's the kind of deep, complex question that understanding the balance of payments forces us to ask.